Hi folks, welcome back to the second part of our video on this textbook problem and the calculation. Now that we've done the calculation of consolidated net income, we're going to go ahead and do the preparation of the actual consolidated income statement using the direct method. So now we're starting with sales, and you'll notice we take the sales of the parent and the sub added together, but we've deducted the intercompany sale that happened between the sub and the parent this year. So the sales revenue is reduced because it's sold to a related party. And whoever picked up the inventory, whoever the buyer was, intercompany, we're also going to reduce their cost of sales. Why is that? Well, don't forget, when they bought it, they put it into their inventory or their purchases, and those two things will increase or affect your cost of goods sold calculation. So we need to adjust cost of goods sold. You remember as well that we made an adjustment for opening and ending inventory profits for year 6. So if we go back to where this $1,000 increase came from, if you go back to your eliminating entries, you'll remember that you increased your cost of goods sold as a result of your closing inventory intercompany profit adjustment because you wanted to remove that pre-tax profit. Why? Because it hadn't yet been sold outside the consolidated entity, so you need to reduce the profit. So therefore, to do that, we'll increase cost of goods sold, all right, and to reduce the profit. And notice here we're deducting $800. Again, the reason we're doing that is because we had a profit shift. We had a shift of profit into year 6 and out of after-tax year 5. So what we did is we added that $800 pre-tax in there and then set up an income tax expense for it. So reducing the cost of goods sold will allow us to recognize the profit in year 6. So therefore, if we go back to our little script here, reducing our pre-tax profit by $800 takes the profit in. So we've got $13,280 giving us a gross profit of $11,060. Now we have to make adjustments to other revenue. The parent had some, the sub had none, but remember the other revenue here, this related to the intercompany dividend that the sub paid to the parent, and the $600 is the intercompany, I think it was management fees or any kind of management or consulting expenses that the parent was charging the sub, and that was $600. So if we wanted to go back here, we probably noted it over here. Oh, where was it? Here, I think, yeah. Consulting revenues and expenses, $50 a month for 12 months. So that $600 was going in as revenue, okay, to the provider of the services and as expense to the recipient. So in our case, what we'll do is we'll adjust it out of other revenue and we'll also adjust it out of other expense. So we're going to get other revenues of $460. Our selling and admin expense is housing a couple of different items there. It's housing the selling and admin not only of the parent and the sub, but this represents the amortization of the acquisition differential on the equipment for year 6. And this also recognizes this $25 adjustment, reduces expense to take in some pre-tax gain on the intercompany sale of the fixed asset. You remember there was a depreciable fixed asset sale. So let's go back up here to our chart. We had here a depreciable fixed asset sale, which gave us $200 of profit pre-tax, and we said we're taking it in over 8 years. So we're going to reduce our depreciation pre-tax by $25 to take in of the $200 that we booked as a gain, separate entity. The consolidated entity is going to take that, divided by 8, and take in $25 pre-tax into profit each year over the next 8 years. So we do that by decreasing the depreciation expense. And they told us in the question that it was part of the selling and admin. So that's going to give us expense of $1,285. Our other expense is going to include our impairment loss on the goodwill. So as well as we said, our consulting expenses, that was booked by the recipient. Now in this case, the $70, if you go back up to your amortization schedule, that's the $70 there. It was the impairment loss for the year. So that's going to now give us other expense of $6,830, which gives us income before tax of $3,405. Now, when calculating your income tax expense, you have to take into account all of the impacts of your intercompany transactions, your inventory, as well as your realized gain that you're allocating into income evenly as a result of the depreciable fixed asset sale. So we know that separate entities had $800 and $680 respectively. But don't forget, we also booked this $800 gain into our consolidated income this year to recognize the profit shift, right? Remember, we had an intercompany sale from the previous year, year 5, and since the consolidated entity has now sold it outside to third parties, we took in that $800 pre-tax, but now we have to pay 40% profit or tax on it, right? And we also had here minus $400, and that occurred as a result of the ending inventory profit that we had. So if you go back to your eliminating entries that we prepared earlier, we had in our closing inventory $1,000 of intercompany profit that the consolidated entity couldn't book, but that also meant that, well, the consolidated entity set up a deferred tax amount for it because recognizing that some entity has paid the tax on it, they set it up as a deferred tax item, an asset, and we reduced the income tax expense for the consolidated entity for the year. So in doing that, we reduce our tax expense, and this is the $10 in tax based on the amount that we recognized in pre-tax profit on our for our gain as a result of the intercompany sale of the depreciable fixed asset. So on this 25, we had a 40% income tax expense increase because we're booking this gain this year and it's pre-tax, so we calculate the tax on it, and that's 10. Again, you can go back up here into your little table and you can see that's the 25 you booked, that's the tax expense on it, so the after-tax increase in income is going to be $15, and that's what we've got here. So now we've got $14.10 in income tax expense. So when we take our income before tax and deduct our tax expense, we're going to get $19.95 in net income. And the attribution we did earlier when we actually calculated our net income, which we did, where did we do that? Right here. Right? We did our attribution down here, and this was our calculation. So you can see everything ties back. Okay, now if we want to do our calculation in the second part here of consolidated retained earnings, the easiest thing to do would be to start with the retained earnings of the parent, which is $10,420. And don't forget, the parent was the one who booked the gain on the intercompany equipment sale. They booked that gain of $200 pre-tax. After tax, it was $120. They booked it in year 2, which was the year they sold it intercompany to the sub, Dandy. Now, don't forget, we've already recognized some of that after-tax profit, that $120. We've already recognized some of it into income from a consolidated perspective. So we're interested in looking at the amount that the parent, Handy, has booked that the consolidated entity cannot yet recognize. So we're interested in the amount that is unrealized. So if we go back to our table just above, we see here that by the time we get to the end of year 5, there's $60 on an after-tax basis that the parent has booked, but the consolidated entity can't recognize it yet. So we're going to remove that. That's at the end of year 5. But don't forget, we're calculating consolidated retained earnings at the beginning of year 6, which is looking at data from the end of year 5. And we know that the whole 120, that's the $200 gain on an after-tax basis at 60%, that's your 120. We know that we've recognized 60 already, but 60 cannot yet be recognized by the consolidated entity. So it has to be adjusted out of the parent's retained earnings to give us adjusted retained earnings of the parent of $10,360. Now we look at the sub, Dandy. their retained earnings at the beginning of year 6, but we can only recognize our share as the parent of the post-acquisition retained earnings. So the sub came to us with $4,500 at the date we became related, but we can only recognize our share of this $680, but it needs to be adjusted for two things. Number one, for the cumulative acquisition differential amortizations, including any impairment losses. So we can get that now back from our chart. So we can go back up here. When we did the acquisition differential amortization schedule, that's your $3,900, and again that's going to adjust your opening balance of the retained earnings of the sub when we're calculating our consolidated retained earnings, which is what we're doing now. And then we also have to adjust it for $480, which is our beginning or opening inventory profit. And you'll remember we made an eliminating entry that included it, right? So it would have shown this to you on the cost basis working paper. We would have seen the retained earning adjustment to the opening balance of retained earnings of $480. All right, so we have to make that adjustment here. All right, and again, don't forget that was the sub Dandy selling to the parent Handy. So we're adjusting their retained earnings by $480. So we get negative $3,700 at 70%. So our share of that negative retained earnings post-acquisition adjusted amount is $2,590. So that's going to give us consolidated retained earnings to open year 6 of $7,770. So now the last thing we need to do here is to calculate our ending balance of consolidated retained earnings. So what we do is we take the opening balance that we just calculated, and again, net income, but this is only the parent's share, okay, of consolidated net income. That's all we're interested in, right? Because the people reading this statement is going to be the shareholders of the parent, right? And they're interested parties. So they're only interested in seeing the parent's share of that consolidated net income. And then we're going to deduct any dividends declared by the parent to its shareholders, which was $1,600. So we're going to get retained earnings at the end of the year of $7,931. Now, sometimes students like to check that. Not a problem. So I've got the check figures here. I'll just bold them. Oh, maybe I won't. Maybe I'll just put them in red. We don't want to throw anything askew. So in this case, we're going to start just to check this figure to make sure we get the same amount. We'll start with the ending balance of the parent. That's Handy, their retained earnings, and that's $10,580. We know that now the unrealized profit on the equipment sale that's in here is $45, because don't forget in year 6 we would have recognized on an after-tax basis $15 of that after-tax gain into consolidated net income. So the only piece that remains unrealized by the consolidated entity is $45. So that adjusts the parent's adjusts the parent's retained earnings to $10,535. Now we're going to start with the sub's retained earnings at the end of year 6, which is $5,400. We're going to adjust for the acquisition retained earnings because that $4,500 was not earned while we were related, so that gives us $900. But we're going to adjust that further for all the cumulative acquisition differential amortizations. So you remember that's your $3,900 to the end of year 5 plus the extra $120 in year 6. So if you want to go back and check that, here it is. $3,900 plus $120, that's going to give us $4,020 in total. And that's our adjustment, all right, to our ending retained earnings balance here. And then don't forget, we've got ending inventory profit. Don't forget, we had that here because we had on an after-tax basis ending inventory profit where we reduced the profit by $1,000 pre-tax and we reduced the tax. So at net, there's a $600 adjustment that is going to reduce our profit, right? So if you go back here, you have to make that ending inventory profit adjustment to the sub's retained earnings because the sub booked that full $600 after tax because it was the seller. It sold it to the parent. So we make that $600 adjustment to reduce our profit, all right? that flowed through retained earnings by 600. So that gives us a net adjustment of 3720 at our share, which is 70%. So we have $2,604. And again, that's negative. Why? Because we started with a positive retained earnings here, but we made all these adjustments to facilitate the consolidation process. So that wound up negative our share. So if we add these two numbers together, we'll get 7931. So that proves that our consolidated retained earnings, using a more traditional method, can still work out if we started with the separate entities ending retained earnings balances. So this concludes our video on this problem. I hope you found it helpful.